In terms of the first presentation, privileged to be joined by Raymond Wong from CBRE. And Raymond's official title is Managing Director of the Americas Research Operations for CBR Limited. Calls Toronto home, spends a lot of time studying both the Canadian and US markets, and very well schooled and knowledgeable on what's going on in today's commercial and industrial markets. So I would encourage Raymond to come on up, and we'll sit with bated breath for what you have to say. Thank you.
Thanks, Bob, for the invitation as well as the nice introduction. So we'll quickly go through some of the highlights over or at least our perceptions of the North American real estate market. Great. The first slide gives you an indication of GDP, and as what you're experiencing in the market, it's basically very slow growth north and south of the border. And the Canadian forecast for 2012 is about 2%, and the U.S. is slightly higher at 2.6%, but it's basically anemic growth in the market. We don't think we're going to hit a double-dip recession in the U.S., but we think it's going to be very slow growth, at least the next 2 or 3 years. That's reflective of the the Fed's keeping interest rates low for the next 2 years as part of their forecast. When you look at the Canadian demand drivers, basically what we're seeing in the market is still growth in employment numbers, but it's mainly been in the last number of years on the financial services side. And we're starting to see a little bit of pickup, especially on the high-tech and the biotech side. But we're also seeing, with the latest employment numbers, a slight slowdown in demand on job creation. And I think that's probably a bit of a lag caused by the U.S. markets, that it had to, with 80% of our exports heading into the U.S. marketplace, there had to be some sort of impact to us economically. And we skirted that the last few years, but I think now we're starting to see some of the impact, especially with the employment numbers going forward. Okay. So if you look at the major job growth by province, Ontario still is the main driver and the engine of Canada. What we're also seeing is a lot of publicity regards to the energy sector and that growth with Alberta. And it depending on who you ask, but apparently every dollar spent on the energy sector in Alberta, between 40 and 50 cents of that is spent on infrastructure or manufacturing spending in Ontario and Quebec. So there is a ripple effect as Alberta improves and grows their economy, that there is a ripple effect on the rest of Canada. And what's going to cause a bit of a shortage, especially the infrastructure growth in Alberta with the energy sector, will be the new ship projects in Vancouver and Halifax. And Halifax, that's where we're seeing some of that growth in potential GDP, as well as the unemployment rate, that we expect that to continue to fall, and that will result in a severe shortage in skilled labor. Okay. So when you turn to the national office sector, okay, when you compare the U.S. and Canada, there's a wide variation here. The year-end 2011 vacancy rate for the U.S. is sitting at 16% compared to Canada 8.1%. Now that 16.1% is not due to overbuilding, but lack of demand for space by tenants. In contrast, Canada, because the employment picture, financial sector, and the high-tech area, there has been some of that demand. And the other component of that, especially in the financial sector, if you look at the growth with the various banks and whatnot, a lot of that growth has been due to their expansion in the U.S. and them relocating some of those jobs up into Canada. And that's why Toronto has done so well in absorbing all that new space, especially constructed over the last 5 years. Okay. And when you look at the actual office vacancy rate on a regional basis, so Canada is basically consistent. Where we have issues is basically on the U.S. side. So in Chicago, we're still at around 20 to 22%. Even Boston, New York has come back a little bit. They're in close to single-digit vacancy rates, especially for the midtown locations. But again, we're starting to see some pushback on the financial services side. That there has been some layoffs, but overall office demand is still relatively healthy compared to at least a couple of years ago. So on the U.S. side, we're going to still continue to see some softness there. We don't expect to hit a balanced market on the U.S. side for at least another 3 years until some of this excess space is burned off. Okay, when you look at the Canadian landscape, it's only Winnipeg that has currently a higher office vacancy rate than their average. But the other office markets across Canada has performed quite well in the way of the recovery, and especially with Calgary and Toronto, based on the amount of new construction, and correspondingly, the rental rates have increased. Okay, when you look at the new supply, again, Calgary swings back and forth with respect to the energy sector. In 2009, 2010, they had one of the highest office vacancy rates in Canada. And what happens in that marketplace is basically the energy sector tends to overreact both ways. So when the oil prices start to go up, infrastructure spending is going up, they tend to lease excess space. So correspondingly, when the market sours or oil prices softens, they tend to give back a lot of space very quickly. So there's a big swing in the vacancy rate, as well as to a certain extent some of the rental rate movement. And for the rest of Canada, there's a little bit more stability. Okay. So when you look at the office cycles, basically we have seen a bit of an increase in rental rates, especially with Toronto. Toronto more so in the downtown. There's still a little bit softening in the suburban markets, but that's starting to. We think that the rental rates are starting to hit its peak, and especially with Edmonton. Edmonton is such a small market that there's basically virtually no space available. But with Calgary, especially with their movement in the vacancy rate and that demand for space in that marketplace, that's going to rapidly move up over the next 2 quarters. Okay. So turning to the industrial market, it's the same picture for the industrial availability rate. So the U.S. is currently at 13.6% compared to Canada at 6.6%. So basically, there's still tightness in supply in this marketplace. But what we're also finding is that there's almost sort of a 3 different levels on the industrial side. You have good demand for space 50,000 square feet under. Those are the companies that are startups that are poised to grow. And then you have the 500,000 square feet above. And those are the big box logistics requiring a lot of space. And there's a gap there whereby we're seeing a lot of the availability rate in that gap. So definitely for the smaller space and the larger space buildings, there's scarcity, and you definitely see a movement in rental rates. Next slide. Again, similar to the office sector, that you're still seeing some high industrial availability rates in the U.S. and you're starting to see the Inland Empire come back with warehousing logistics. There's been a lot of noise about the expansion of the Panama Canal, whether or not that's going to have any influence, especially on the East Coast. And what we're finding is that, especially with the amount of infrastructure that's been spent over the last 20 years with the Western U.S., that infrastructure and the transportation via rail and trucking is so efficient that even though there's a widening of the canal, the costs are still higher by shipping it through the canal and bringing it up the coast. The other challenge you have is that the infrastructure is just not there yet to handle that much more excess capacity in your Houston and the Eastern Seaboard. So we don't expect any immediate changes because of the expansion, but we think over the next 10 to 20 years that there will be some impact of the expansion. Okay. So when you look at the logistics, and warehouse, as everyone knows, is very closely tied to the retail sector. So logistics has been increasing, especially over the last 10 years, and that's also due to sort of the clustering of your super warehouse for efficiencies for the retailers, but as well as the number of new retailers that have come up into the Canadian market. So we're going to see this trend continue, especially the push for efficiencies in the major markets. Okay. And what we're also seeing, and this is a bit of a contrast, that the manufacturing sector in both Canada and the U.S. is doing quite well, and that's also partly due to the auto sector, and you're seeing increase in to a certain extent the disposable income. So you're seeing the auto sector in North America come back, so that's causing growth, especially in the auto sector. Okay. So with respect to right across the country for availability rates, again, it's still relatively tight, and again, it's tighter for the larger logistics, anything over 500,000 square foot buildings. With Montreal, they're experiencing what Toronto experienced about 15, 20 years ago with respect to functional obsolescence of space. So if you look at the newer buildings with high ceilings, there's actually probably a scarcity in the market, but in the older buildings, that's what's pushing your availability rate up. There's still good demand in the tech sector, the warehouse, less so in the manufacturing. They've been really hit with the recession with the U.S., but their industrial market, especially for the better quality space, is quite strong. Okay, we're turning to the retail sector.
Look at that, it loaded. Yes. Live pulling. It actually loaded. Yeah.
Yeah.
Give it a shot.
So Raymond wanted to know if any of you personally are planning on making a big ticket purchase this year. So what you do is you text one of the codes, either yes or no, and the phone number to text it to is 37607.
So does it? Oh, okay, cool.
Look at that. There you go. Ooh.
Wow.
Who's the big spender?
There you go.
So Raymond, is this what you would expect to see?
Yeah, and this is what the challenges with polling is that, especially with
We finally
yeah.
got it up.
Can we go back to the other one? The other one supported my analysis better than this one.
We can try that. Who's
You
up
want
for
to
it?
go back?
No, it's okay. I just have to change my rationale based on.
It's a flexible presentation.
Anyways, with this poll is what we're finding with our consumer confidence is that what people comment with the poll is very different to what was actually happening in the marketplace. So this one is basically indicating that everyone is pretty confident about the market and that they're anticipating spending this year. So if you turn to the next slide. So with respect to consumer confidence, it is coming up, but it's still at a relatively low level. And when you look at the actual retail spending on the next slide, that what we're finding is that even though that, especially on the U.S. side, that consumer confidence is down, that the overall spending is up. And granted, a lot of that is based on necessity items, but we're also seeing a big swing in luxury items, and that's, I guess, relative to the poll by this group, that you feel a little bit more confident with the economy that you're willing to spend. But we found that when we're looking at some of the stats, that what we polled with the consumers and what was happening in the market were two very different things. Okay. So with the retail sector has been resilient, especially with the Canadian market. With new construction, we saw the vacancy rate uptick slightly, but it sort of corresponds with the housing sector, that especially with the new areas and redevelopment of some of the projects that we've seen that movement. Even with the U.S., even though the vacancy rate went up, that now we're starting to see retailers going through their strategic planning, repositioning some of their stores, that we're starting to see some shortage of retail space, especially for the big box and some of the urban areas. And that's one of the key areas that we're seeing in the big cities with urban retailers, with sort of a smaller concept grocery stores are locating in the downtown, catering to the new condominium owners, so on and so forth. And one thing that we started to see on a global basis with some of the industrial stock is that it's to service the retailers in the urban areas. We're starting to see multiple floors for industrial for their products with efficiencies. So as the urban population grows, we're going to see more of that multi-level industrial. But again, we're starting to see it. It's not an overall trend yet, but for certain markets, we're starting to move that way. Okay. So again, this is no surprise with respect to the number of new retailers that have targeted the Canadian marketplace, and especially with the way that the Canadian economy has been progressing, and to a certain extent, the close proximity to the U.S. has just made a whole lot of sense for them to move north of the border. And again, this is reflective of the increase in demand for industrial space, and especially on warehouse logistics, as these new retailers move up to the Canadian market. Okay.
Time for our next live poll.
Oh,
All right.
Are they charged when they actually answer the question? Is it $1, $2? Yeah, multiple times.
perhaps. Is that a good answer? It depends on your plan.
Okay. Wow, how often does this?
So as people text in, the numbers will change.
One thing we should have, if we could have cross-tabbed some of these questions, it also relates to the demographics and the age of the group with respect to expansion. And again, if we can sort of freeze it here, that's just, oh, again. But the majority, it's basically staying in the same size of space based on the market prices and the cost to expand. But I think we'll see a little bit more downsizing or in the next 5 to 10 years. And again, this is sort of more of a Canadian thing with respect to rental, and Toronto, whereby Montreal is a lot higher in the way of people deciding to rent rather than to buy. Okay, we'll go to the next.
Yeah. Well,
So-
we have the right.
So in the U.S., when we talk about the U.S. Residential market, that you see the home ownership rates, it's been on a steady decline, and that's been largely due to the number of foreclosures, and this is again related to the retail sector. That when we see this trend almost 2 years ago in the U.S. with an increase in rentals and again number of foreclosures, the retail spending actually went up, and that was because the increase in disposable income, and as people had more money based on renting rather than owning, so it's directly proportional. But what we're anticipating in the U.S. Residential market is sort of flattening now, that the foreclosures are still going on, but at a slower pace. So you're still seeing, and most of the foreclosures and heavily discounted prices are in sort of your Arizonas, your Floridas, but it's not in all locations, because there's certain prices in Floridas whereby prices have not moved, they've actually increased. So depending on where you are and depending on the amount of development and oversupply, it really varies on a state-by-state, on a regional basis. But this is why also the U.S. multi-residential market is doing so well, and that's where we're seeing new construction take place in the multi-housing sector. Okay. So George is going to present later, and he's probably really going to just disagree with my comments here, but that's okay. Yeah, we've seen the average home prices, and the recent survey shows that it continued to move up. But the gap with affordability and the prices, the only thing that's keeping this market going is basically low interest rates. So the concern over the next couple of years is whether or not the interest rates will sort of remain flat. And I guess with CMHC limiting their protection, I think it's about $600 billion, so they're getting close to that number, right? So they're getting a little bit worried about the overexposure. And the only thing that's going to take this market down is if interest rates move up significantly quicker than where they are. If they move up between, I think, 10 to 30 basis points, I don't think it's going to impact. But if they move up 50 to 100, then there's going to be people struggling who are sort of taking advantage of the low rates and the short terms, and basically leveraging their lifestyle to afford these homes. So we'll see when that happens. So that's the biggest concern with this marketplace, that I think there is sort of a bit of a bubble in the marketplace, but nowhere close to the same extent as the U.S., because I don't think you had that same amount of lending, and there's a lot more discipline with the Canadian banks. But I think there's a little bit of frothiness in the market that will cause a bit of a correction, but it's all dependent on interest rates. Okay. So this slide here, again, gives you the average resale price. And this also gives you an idea of what's happening, why prices are going up. Basically, your number of new homes is declining, and the actual listings in the market is declining. So there's a limited number of inventory in the market, and especially with combination of immigration, combination of people buying their first homes, that's because of the lack of stock and lack of choice that is pushing prices up. Okay. And again, if you look at the housing starts across Canada, it is up over the last couple of years, but again, I think we're going to be a little bit constrained with the number of alternatives over the next 2 to 3 years. Okay. So when you look at the CMHC vacancy rates, and if you look at the average rent, again, this doesn't include the condo market, but And I think the condo market on the rental side is not going to move the vacancy rate up much higher. Again, it is depending on where you are. But on the multi-residential side, this is why your cap rates are so low, and because of the lack of available space and sort of the consistent income flow. Okay. Quickly turning to the national investment side, and this number here. This is sort of a forecast. We're still waiting to confirm a few numbers for the year-end 2011 numbers, but we're going to exceed 2008, and we're still quite a bit away from 2007. And partly this is due to the lack of large portfolio sales, or the lack of product in the marketplace rather than demand. There's still quite a bit of demand in the market, but there's just not a lot of supply to keep up with it. And especially with this year, with Scotia Plaza on the market and perhaps a few others, we probably will see more of an increase in investment activity for 2012. This is sort of a breakdown. Again, this is showing 60.3. Our investment numbers will be released next week, but we're just finalizing it. But you can see where that growth is occurring, especially on the office and the retail sector. That we are anticipating over 2008 levels. Okay. So this just asks where you think the values are heading over the next 6 to 12 months. We forgot to add that part.
6 to 12 months.
We can tell everybody.
Wow. Yeah, what this poll indicates is that it depends where you're looking at and which markets you're in, because especially in the office sector in your urban areas, Vancouver, Calgary, and Toronto, that you definitely will see a little bit more compression in the cap rates. But when you look at the secondary markets or the B quality stock, you're seeing a little bit of more demand compared to the last in the last 24 months. But you're still you're having fewer buyers in the marketplace. And if you recall 2005, 2006, 7, that when you looked at a cap rate for a retail center in Sudbury compared to Toronto, the cap rate was maybe 50 to 100 basis points difference. But now that gap is a lot wider, and depending on where you are, that you will see more movement than others. So I would guess that it'll be the same or down slightly with respect to the Class A investment product, and I think we're going to see some definitely upward pressure in some of the prices, starting to see in the secondary markets, just because of where they are right now and how far they've dropped to a certain extent. Okay. Well, this was at it. Sorry. what this was supposed to indicate, sorry, I thought we took this out, but I'm not sure if you can spot the differences of these two projects. And basically the difference between the two is between $30 and $40 a square foot, depending on where you are. So you can have the identical building in an urban location and suburban or secondary market, and definitely the price points are quite different. Okay. So when you look at the U.S. cap rates and the forecast, you see that 40% decrease in values in '07, and you see that rapid recovery in the numbers. And the key to this is basically the type of transactions. A lot of these transactions are reflective in where the market was most active, and that's your urban areas, your Class A trophy type assets. And we are sort of forecasting sort of a bit of a increase in cap rates, and that's because of where the cap rates are today. And we think that is a little bit frothy in certain areas, especially if you add the activity in the secondary markets, that there should be a bit of a correction in the marketplace. Now, that's one thing that we're seeing a lot of activity. A lot of activity about 3 or 4 years ago was basically on the Canadian side, but there's been a lot of movement in the U.S. and for especially the foreign buyers looking for distressed assets. But even with the Canadian pension funds, they're definitely investing abroad in the U.S. and especially in South America and a little bit of Asia, but definitely not Europe at this point. Okay. And the Canadian side, again, it's heading the same trend. And multi-res, again, based on a low vacancy rate, you're basically clipping bonds at that rate. The only concern with respect to some of the activity in this area is that the exit strategy is a little bit sketchy, especially if you're buying some property at 5 or 6% cap. The income levels will increase marginally over the next 3 to 5 years, and for exit strategy to get a large gain, it might not be there. So I think a lot of the emphasis right now is to focus on stability. Okay. So the key takeaways is going to be a low interest rate for next at least I think for at least the next 24 months. There's not a big impetus to increase it, and especially inflation to a large part is controlled, but you never know based on what the impact with Europe and oil prices. Consumers will continue to be cautious with their spending. We're definitely seeing on the Canadian side a little bit of pullback. And economic uncertainty. Corporations are hitting all-time highs on their profitability, but they're definitely not hiring at this point. And there's a delayed impact there, and they're waiting for a little bit more consistency in the markets before they take on any type of expansions. And market fundamentals, again, we're going to see probably some slow movement in the U.S. and Canada to a certain extent. If you look at Calgary, you look at Toronto, where the rates are right now, they're already moved up quite quickly based on the vacancy rates. So you still will see slight increases in rental rates, but not to the same extent over the last few years. And investment activity will still remain strong, but the challenge there is finding the product, and as well as some movement or refocusing or rebalancing the assets. Okay, I think that's it.